what we'll do is we'll convey that, let's say we have an ETF that has 3 creation units, each with a unit of stock A, B, and C. We'll convey that we would like to replace C with stock Z. They will go out, they will do a standard creation unit of A, B, and C, thereby creating, now we have 4 units of A, B, and C. And then on day of rebalance, they'll redeem a unit that will consist of 3 units of C. And thereby now you have 3 units that are, not to convolute it, but A, B, C, A, B, A, and A, B, B. And essentially what you do now is you just sell out 1 unit of A, B, C, buy the 3 units of Z.
But I think that the shorter term fundamental picture is quite negative, and the shorter term technical picture, as we'll talk about in a few minutes, is incredibly negative for a number of the bellwether heavyweight FANG names that dominate the index. And as those stocks roll over, I think it'll take the index hard down. And so we've kind of laid out or mapped out what we believe will be a 5-wave motive wave decline, which ultimately should terminate around S&P 2250. We see that happening sometime early next year, probably in the first quarter.
Do you think the trend of value over growth has legs?
We do. We continue to think that we are just in the beginning phases of a secular regime change, right? And history has shown us that higher rates and inflation generally causes, a repricing not only in the equity world, but also in fixed income assets as well. And this is exactly what we've seen over the past 1 to 2 years as value-oriented equities have drastically outperformed the growth-oriented peers, quite substantially as well.
The problem with thinking that it's overdone is that we've just come from a big bounce. It would be overdone if we'd been selling off January, February, March, April, May, June, July, August, September, but we didn't. After the June sell-off, midpoint of the year, we rallied 20%. So much capital was drawn into the market. You have prominent strategists, technicians calling the lows, saying it's in, new bull market. And because of that, when you start to unwind a bounce like that, a 20% bounce, exactly, right, 8 weeks, June 16, 17 to August 16, 17, that money that takes a lot of it to force the market up that much becomes an accelerant on the way out.
So, I think there should have been, when you talk about active management, to me, active management should be active. And, it's obvious the trend is down. We failed at the 200-day moving average a few weeks ago, creating another downtrend. So if you're an active manager, you should have noticed this. Unfortunately, you've got a lot of portfolio managers who have to be fully invested. So, lately you've seen Apple, for example, jump up a lot on certain days, and people come out, Apple's this great stock. No, portfolio managers are using Apple as a cash alternative.